Welcome to Lickin' on Lending, the podcast that dives deep into the heart of the mortgage industry. Your host, David Lickin, bringing you the latest insights, trends, and updates from the world of mortgages. Whether you're a seasoned industry veteran or just getting started, this show is your go-to source for all things mortgage. Let's get started. This is Lickin' on Lending. Now your host, David Lickin.
Listeners, I'm really excited about our guest today because as a mortgage lender who's been in the business for 51 years, I admire people who find their way to reinvent themselves and stay relevant to what's going on in the industry today. And today's guest, Jeff Bodie, who's the president and CEO of Click and Close, who's just been a part of a Mid-America Mortgage and has had a great story. I just met with one of his generals, Jeffrey Rake, and I was so impressed with how Jeffrey talked about Jeff Bodie. I go, I know Jeff Bodie. We got to have him back on the podcast. So, Jeff Bodie, it's so good to have you back, sir. I respect you so much.
David, it's great to be here. Thanks for having me.
You have been an icon in our industry for a long time, and I thought we would cover briefly a little bit of your journey. When you started the industry, I think it was in 1981, if I recall correctly, and then walk us through your journey to where you're at today.
That's a long time, but yes, I started in 1981 in a savings loan in Western Oklahoma. I worked for a couple of savings and loans, and then the savings loan industry in Oklahoma just crashed in 83 and 84. And I moved down to Texas in 1986. And with that, I had a joint venture with a little bank in Frisco, Texas. Unfortunately, they'd already made all the bad loans they needed to before I even got there, and they eventually failed. And while that happened, I ended up buying a brokerage company that was part of a company called Custom One. It was Mortgage One. And I acquired that, had the employees, and then I put some additional capital in and made it a mortgage company, very small mortgage company. And we built that up on a retail basis, got our FHA, warehouse lines, the typical broker to banker solution. And then when I saw DU come about, I thought that's a great opportunity. And we decided to get into the TPO business and utilize the DU underwrite. And something really fortunate happened. It was Contour software. And Calyx Point, one of our loan officers saw that and said, this is pretty good. Or I went to a Fannie Mae seminar where they were rolling out DU. And I said, we've been trying to do this, but it is so clunky to use our software system. They said, hell, this is Calyx Point that we've been using on the demo. And I thought that was really slick. So we called Calyx Point, bought 8 licenses of it, and made that work. And we called the owner, or actually just called their helpline, and said, boy, it should be nice if it did these 4 or 5 things. And with that, the owner of Calyx Point flew into Dallas and sat beside my loan officer that was going through that stuff and, pointed out, here's what it's missing. And a couple of weeks later, they gave us a software that did that. So that was really impressive.
Now, there's a really good point right there in that part of the story is you look at successful people, they fly in to meet with their customers when they hear of an idea. And I just want to underscore that a lot of people are saying, how can I be successful? I would suggest that you need to go in and become a part of a seat next to your customer. And that's what he did. Calyx Point obviously was wildly successful for so many years. It faded from existence, but kudos for you for making the switch.
Yeah, and that really worked out well. And what was funny that later on, a couple years later, Calyx was working with Flagstar to roll out lenders in Point, and they had done a great deal of work. And I guess Flagstar was changing their operating system. And Calyx said, we need somebody to do this with. And they remembered those conversations we had and said, how would you like to be the first lender in Point? And we didn't have a whole lot of capital. It cost us about $500,000 to build out the process. We did that, didn't have much cash left, but did that. And that was such an easy system for a broker to be able to.
Oh, it was. Yeah. Such an easy system to use. Yeah.
Yeah, it really was. And we were able to just grow rapidly. And it was bizarre because as soon as the new version of Calyx Point rolled out, they saw our name in there and we got tons of calls.
Oh, really?
Fortunately, we weren't licensed in California, so we couldn't take advantage of it all, but that was pretty amazing.
So, Jeff, you then worked with Calyx Point, but you continued to reinvent yourself. And what I think is so interesting, what was your mindset of what were the opportunities? What was going on in your head? I'm trying to give our listeners insights into why you were able to reinvent yourself, whether it be moving to Calyx Point in the early days of that to doing the different things that you've done. What is it about the way you're wired that it causes you to be willing to shift? So many people get stuck.
As an entrepreneur, I've always been, my mind doesn't turn off. I don't think I'm any brighter and probably not as bright as most people in the business, but I'm always thinking about it. And how do I do something better, easier, smarter, take advantage of a particular pricing execution opportunity I can? The mind never turns off.
Yeah, that's good. When your mind there's different things that go on in different people's heads. Some people are seeing opportunities. Other people are seeing fear. Obviously, you are recognizing opportunities. What are some of the inflection points as you continue to tell us about your career path that allowed, for example, one of the things I read in your bio, you were one of the very first independent mortgage lenders in the nation to implement the e-closing, the electronic closing, as well as e-notes. How is it that you seem to catch on when that has been one frustrating late to adopt technology?
It made sense to me that when Dodd-Frank came about and we had to have the intent to proceed document signed, and I thought that's got to be signed electronically. We've got to deliver our electronically in order to keep the process moving and going faster. I thought, well, since we're doing that, why don't we just move to e-close? And it had occurred to me that the thing about e-close, it's not what the consumer wants particularly. They just want everything correct and on time. But it did help allow us to get everything correct and on time. One of the things that you have with an e-close process is we actually load all of our documents up into our closing system. Prior to that, we were actually emailing a link to the title company to get the closing docs that our document preparer put together, but it might not have had like the tax return information on it that they needed to sign, or a letter of explanation that they provided us that they didn't sign, or whatever document. And we found that we were having problems with our title companies, and not that they were bad, but we were sending them emails to sign these documents an hour before closing. They'd already printed everything out, and they were going to have those documents signed. They didn't go back to check and see what we just thought of at the last minute. And we had found that going back and chasing down those documents took a tremendous amount of time. And that was a big lift for us. And the consumers liked it better anyway. And ultimately, the title companies, they didn't like that back and forth business either. They wanted everything in one package to be signed. And we actually got the borrowers to sign those documents. We just left them. That was prior to the remote online notary solution, but we left everything that had to be notarized in our closing package. The title company printed that out, got those notarized, as well as the deed that they filed. It was just a pretty easy, slick process for us. And it was just better communication for lack of having to communicate is where it was.
It makes a lot of sense. Now you've evolved into click and close. How did that happen?
In 2022, I looked at the industry and thought, oh man, this is going to be rough. I think interest rates had already moved up, and I thought they're going to head up further. And I really didn't want to be running a retail operation at that time because I'd been through that before. That There was just not enough that you could do to provide to give the loan officer to be better than everybody else. And they all wanted to be better than everybody else.
At your expense.
Yes, that's typically the case. And my thought was, why don't I just do wholesale? Because we had our down payment assistance product already put into place. And that I could see that as a winner going forward. Typically in downtimes that people don't have the downtimes in this industry,
right?
But people that have money have already financed.
Right.
The ones that don't have money are looking to figure out how to buy a house, even though they might have the income. We thought that was a good niche product.
Yeah.
And we started building that in 2020 and had it ready. And it was, I shouldn't say perfected. We never get anything perfected. I don't know who does, but
I don't know. Not technology. It's moving too fast.
Yeah. And our solution was to have that available and to market that on a wholesale and then correspondent basis.
It's pretty impressive, but it's more impressive to me who you've been able to attract into your organization. You got guys like Jeffrey Rake who are just quality human beings. What is the key to your recruiting and being able to attract seasoned professionals like Jeffrey?
Well,
And his
that-
wife, by the way, as well. Jeffrey's on the TPO side. I believe his wife's on the correspondent side, if I'm not mistaken.
Yeah, she's wholesale and Jeff is correspondent.
Oh, is that okay? Jeff's correspondent. Okay.
I think you just have to hire the right people and let them actually. Michael Lima was the one who brought Jeff Reich in.
Okay,
And,
it's Michael that did. Okay.
And I'd known Jeff for years. I never thought to ask him. There's so many people that you know and you respect that are out there in the industry, and you just never realize that they may have a change of life, that they would like to make a move.
Yeah, a big shout out to both Jeffrey and his wife. They were in Cancun at the Lenders One conference that you guys are members of, as I am, and it was really great to get to know them. I just think the world of the two of them. So quality people like yourself.
Yes,
So
they
what is the vision of Click and Close then?
the thought is that we would be a digital process. And I think we're getting close to that. We're building our own point of sale inside of a mortgage machine. We've been using Blend for, 4 years. No, probably about 6 years. They do a good job. But we'd like to take that further so we can have our third party wholesale customers utilizing that and taking advantage of day one certainty and AIM and giving them instant approvals and a better process along with the digital closing with the remote online notary and the e-notes. So everything's wrapped up in a really tight package and easy for the broker with great pricing.
It's interesting when the name Click and Close is implying a much more streamlined process, if I understand. And has that been realized, Jeff?
I think parts of it have. I mean, obviously, whenever we had the e-close process back when we were Mid-America, I do think that really was beneficial. And I think the title companies would say, yeah, that was great. And I think we were probably a year or two ahead of everybody else before they embraced that.
Yeah. One of the other things you're famous for is finding niches. I've always been impressed with the niches. One of them is the down payment assistance program that you have. As a result, I met Rob Crane, who is with a down payment assistance resource group, and he started this years ago, slaved away at this thing with a vision to help people get into homes. I love the vision. That's where I got hooked on this industry. It was 51 years ago, is helping someone get into a home that everyone else didn't think they were qualified for. I got them into it, and we're still friends to this day. The very first loan I did, I'm still friends with the people 51 years later. That's what we could do in this business. And I was impressed with Rob's vision to help people get into homes. And so you've locked onto that, and you've created a program and built systems around what Rob is doing. And I think you call it with zero out of pocket. What's the name of it? It's the Smart Buy. Click and Close is Smart Buy. Talk about what you envisioned there and how you're working with Rob.
We figured the Smart Buy product was a great name because they didn't have to have a down payment. And actually, we've got some solutions with the Smart Buy product with the shared appreciation, which actually has the borrower paying less money out of pocket to close and having a lower payment than they would had they gone a traditional down payment assistance.
Oh, really?
And yes, what we're doing, the Redco, the investor, they actually get a share of the appreciation on the property by subsidizing the interest rate. So it gets the borrower qualified, but then they have to.
That's a brilliant move. That is. Did you come up with this?
We did.
And how did you find the investor to work with you on that?
We've been working with Redco prior to that, and we've actually helped Redco with their investors that utilize acquire the opportunities for the shared appreciation. But one thing that we found on this shared appreciation, unless the appreciation exceeds 5% per year, the consumer is still better off cash flow wise, even at the end of 5 years, by taking advantage of this. And part of it is a function of how the securities are trading right now. I think everybody's a little nervous that interest rates, or the investors that buy loans are nervous that interest rates will drop. So if they really don't pay much of a premium, and generally most lenders have at least a 3-point margin to close a loan. So there's really not much of a premium price. So that costs the borrower a whole lot more in rate. And we're actually able to buy that down 3 points and put it into the shared appreciation.
Wow. And you're making this available to those that are brokering loans to you as well as those that are corresponding with you. Am I correct?
Right now, yes, we are.
Okay, good. Having the two channels, I wanted to be sure that was the case. Now, are there any DTI, debt to income restrictions on this program?
We want to make sure that borrower sticks. We're trying to keep it at about 50%. We'll make some exceptions. And frankly, the underwriting engines are they're fairly picky on that. Once it gets over 50%, you've got to have some other things going for that file to make it work.
Yeah. What are some of the other products you're working with, like manufactured housing? I think in our conversation is you're doing a lot in that particular area.
I wouldn't say a lot, but we make that available on all of our products.
Yeah. How does the shared appreciation, that really appeals to me, especially when you're looking at being able to get a lower payment and you're giving up something in the appreciation of it. But what a great way to get people into homes. How long does someone have to be in a shared appreciation program before they can refinance out?
They can refinance out whenever they wish. The second mortgage requires that they share the equity after 5 years, and that loan won't be released until that 5 years is up. But we would subordinate the first mortgage. That wouldn't be a problem.
We should probably get into how the shared appreciation program works. It's a second mortgage program?
It is.
And so you have your first mortgage, and the first mortgage presumably would go through you on that. So that's a pretty standard program, but the shared appreciation comes as a result of the second mortgage. Get into that a little bit more, in a little more detail.
Yeah, the second mortgage piece is what dictates the terms on the shared appreciation.
Okay.
So if they close on that combined loan, they have to share that appreciation later on. But I think the interesting part about it is just analyzing the cash flow. We've got a calculator we have on our website that somebody can look and see, okay, based off of this appreciation in rents or this appreciation in the value of a home, here's where I'm going to end up. And virtually every time, unless you have inflation or appreciation exceeding 5%, they're way better off with the shared appreciation.
Oh, absolutely. Especially in this market where it's not exactly appreciating. Most areas are not appreciating right now. That's right. Where do you see the market going? What are some of the new trends? If we get into your crystal ball a little bit, because you've been very successful in guessing where the market's going and made some wise moves in the past.
One thing I'm seeing in the secondary market solution is the Ginnie Mae TBA market really doesn't have a whole lot of opportunity. You're seeing just the VA loans in there.
Right.
So spec pools is where it seems to be the big beneficial solution. As a matter of fact, over 65% of our loans go into specified pools, either low balance loans, the down payment assistance loans, rural housing loans. They've got some feature about them that they won't prepay as fast as just the regular FHA solution. And that's been a nice opportunity for us. We get a little better price, a little better execution on those loans as we securitize them.
Yeah. Jeff, I just compliment you on how you have been able to continually morph and shift with market conditions. You've got a great company. How can people learn more about your company? By going to your website, I'm assuming, Click and Close?
Yes, that's it. And just do business with us.
Yeah, start out. The nice thing is you can do business on both a broker basis and a correspondent basis. What is the minimum requirements? I'm assuming a broker, so long as they're in business and good standing, there's no real requirements other than just you'll pay. Is there a net worth requirements for a broker?
I don't think we have any for the broker.
Yeah, I did think. But for a correspondent, I'm certain you must have some requirements.
You've got the minimum FHA requirements that are out there. And we're primarily a government lending shop. We hope to make a change sometime late this year, early next year, by virtue of some technology that we're going to roll out. Our new point of sale, we think that's going to be very valuable, that would make us competitive on those products. Yeah. Right now, UWM and Rocket make it so easy for their brokers to do business. We want to be able to compete with that.
Yeah, it's important that you be able to do it in order to stay in the game. But I'm confident if anyone will, you'll figure out a way to do it. Jeff, thanks so much for taking time out of your busy day to join us today. And listeners, I just want to encourage you to get to know Jeff. Take a look at his LinkedIn profile. We'll put that in the show notes here, and also a link to Click and Close. I love the Smart Buyer program, the Smart Buy program, as well as the Smart Shared Appreciation program. These are real niches, listeners, you could use for your business. Jeff, thanks for being with us.
Thank you, David. It's my pleasure.
You bet. Listeners, I want to say again, thank you to our sponsors that make this podcast possible. Byte Software, Finastra, Angel AI, True, Candid, the Mortgage Bankers Association of America, as well as Lenders One, the Mortgage Collaborative, Modex, Knowledge Coop, Redder, Mortgage Advisory Tools, and Fuel. Folks, have a great rest of your day. Share and like this podcast, and we appreciate you being a part of our podcast community. Thank you.
You've been listening to Lickin' on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lickin' on Lending.